Welcome to Finance Trice, the world's modern broadcast hub for all things finance. From investing strategies to economic updates, from crypto insights to real world money lessons. Every broadcast is designed to help you think smarter, plan wiser, and grow.
Imagine you're staring at your screen and you see this opportunity. You have $221 available, and there's a specific mathematical scenario that suggests, if certain events align just right by the end of the month, that small amount could multiply into $100,000.
Right. It sounds like a scene pulled straight out of a Hollywood script, doesn't it? Some kind of hidden financial loophole.
It really does.
But the reason that, that $100,000 potential is even mathematically possible is because the other side of that trade, the opposing side, carries an equally dramatic or at least theoretical threat of unlimited loss.
Unlimited loss.
That asymmetry is the entire foundation of options trading.
Exactly. Welcome to the deep dive. Today, we're taking the sources that our listener, the learner, sent over, and we're moving past that simple world of long or short futures trading.
Yeah, that binary world.
We're diving into the complex, customizable architecture of crypto options. And this isn't just about guessing a direction. This is about structuring your profit and your risk with, almost surgical precision.
It's like finding the hidden matrix beneath the charts.
It is.
And this is, I think, a crucial deep dive for anyone who's looking to mature their trading approach. Futures trading, that's the entry point for leverage, sure. But options are the advanced toolkit.
Right.
So our mission today is really to break down the very specialized language and the mechanics, moving you past that binary thinking of just up and down and into the ABCD of options.
And this allows you to profit when the market flies, when it crashes.
Or, and this is the key differentiator, when it stands perfectly still.
So let's start there with the fundamental problem. Why do we even need options? If the market is going up, I just use leveraged futures to go long. If it's going down, I short. Why add this extra layer of complexity?
That's a great question, because futures are, you're right, beautifully straightforward. But they are absolutely directionally dependent. Your profit depends entirely on the price moving where you want it to go.
And moving fast enough.
And moving fast enough to cover your funding rates, exactly. Options, fundamentally, they allow for far more complex, customized profit structures. You're not just betting on direction, you're betting on price levels being achieved by a specific date.
A specific date. That's key.
Which lets you capitalize on market volatility or, and this is the really interesting part, the sheer lack of it, which is just impossible with standard futures.
Okay, let's unpack this separation. When you think about traditional trading, you usually think of futures. You put up a small amount of margin, maybe 10% of the asset's value, and you get exposure to the full contract.
Right.
And if the price moves 10% in your favor, you've doubled your capital. But if it moves 10% against you,
you're liquidated. That's the perfect futures context. It's high octane. Leverage acts as a simple amplifier. High potential profit and an equally high potential for, total loss.
You're betting purely on momentum.
Purely on momentum and direction. And the contract, if it's a perpetual future, it never expires, so time isn't a factor. But that liquidation threat is constant. It's always looming if you're aggressively leveraged.
So when we say options are very different, we're not just talking about a slightly different flavor of leverage. What's the core, almost philosophical distinction here?
It's the shift from an ownership commitment to optionality. The name is literal.
Okay.
Futures obligate you. If you buy a futures contract, you are obligated to buy or sell that asset at the agreed price. Options, on the other hand, give the buyer the right, but crucially not the obligation, to buy or sell at a specific price.
That's right, but not obligation. That changes everything.
It's a profound asymmetry. It moves the leverage away from capital, how much money you control, to probability and time. The core distinction, as the source material really highlights, is that options let you bet on specific price levels by a specific finite date.
And that finite date, that introduces time as the primary enemy for the buyer.
For the buyer, yes.
And we should probably ground this in reality. These sophisticated trades They require specialized environments, right? Like the Delta Exchange India platform that was mentioned in the source material.
Absolutely. This is not your standard crypto exchange interface. To interact with options, you need access to what's called an option chain or an option table.
A table, not a chart.
Exactly. This table is the real-time menu of all the possibilities, and it's organized not just by price, but by expiry date, by strike price, and the associated premium cost. It's a completely different visual and structural landscape.
Which immediately brings us to the four basic components, the ABCD alphabet we need to learn before we can, write these financial scriptures.
Precisely. We have call, put, buy, and sell.
Okay, let's start with the first one.
First, the call option. If you buy a call, you are speculating the price will rise significantly. You're basically calling the asset higher. The buyer purchases the right to buy the underlying asset at a specified price.
And the person on the other side of that.
The seller of that call, they're taking the opposite bet. They're selling that right, betting the price will not rise high enough to make it profitable for you.
Okay, and then we have the bearish counterpart, the put option.
The put option is the right to sell the underlying asset at a specified price. So when you buy a put, you're speculating the price will fall.
You have the right to put the asset away at a high price, even if the market has crashed.
Exactly. And the person who sells the put, they believe the price will stay steady or rise. The source mentions them as call European or put European, but the core idea, call for up, put for down, that's the essential starting point.
What really stands out to me here is the capital efficiency. In futures, I might need, say, $5,000 in margin for a 1x Bitcoin contract with 5x leverage.
Sure.
But the source showed buying a full contract far out of the money might cost only $221. That is a massive difference.
It's a game changer for smaller accounts. That $221 payment controls the full directional exposure of one Bitcoin. You're using a tiny amount of capital to leverage probability, the chance of a massive price move, rather than leveraging your principal. It's a much more efficient use of capital for speculation.
All right, we need to nail the vocabulary here because options trading is full of this very specific technical language.
Right.
Let's walk through the hypothetical trade mechanics from the source, starting with the concept of the strike price.
The strike price. It's the predetermined price level at which the option holder has the right to buy or sell the asset. So using the example from the source, if Bitcoin is currently trading near, say, $89,700.
Okay.
The option chain presents a menu of strikes. You'll see them spaced out maybe in $200 or $500 increments. So you'll see 89,000, 89,500, 90,000, and so on.
So when I buy an option, I'm choosing a specific price level I think the market will hit. I'm not just hoping for any old price movement.
Precisely. And that leads to our critical definitions. At the money, or ATM, and out of the money, OTM.
Let's start with ATM.
At the money, ATM, is the strike price that's closest to the current market price. So if BTC is $89,700, the $90,000 strike is ATM.
And that one's probably pretty expensive, right?
Relatively, yes. It carries a high premium because there's a strong probability, roughly 50-50, that the price will move in favor of the buyer or at least finish close to that strike.
And conversely, the big, high reward, low probability bet is the out of the money OTM strike.
Right, like the $100,000 strike when Bitcoin is sitting way down at 89,700.
A long shot.
OTM strikes are distant. They're cheaper to buy because they require a massive, improbable black swan event to become profitable. And this is where the highest theoretical leverage really lives.
And I guess we should mention in the money, or ITM, too.
Briefly, yeah. In the money ITM, options are strikes that are already profitable if you exercise them immediately. So if BTC is at 89,700, an $85,000 call option is ITM. They're the most expensive because they already have intrinsic value.
Okay, now let's bring in the element that is totally foreign to anyone trading perpetual futures. Expiry. Options are finite. They are ticking clocks.
Time is the crucial constraint here. These are time-bound contracts, daily, weekly, monthly. The source examples referenced expiries like the 16th or 26th of December.
And if you buy that $100,000 call expiring on the 26th and BTC only gets to 95,000 by then,
your contract expires worthless.
Yep.
And that brings us to the premium.
The premium is what you pay to get that right. It's the maximum you can lose as a buyer.
And the maximum a seller can gain.
Correct.
And the calculation of that premium, that's where the real science of options trading comes in. The cost isn't arbitrary. It's determined by a complex interplay of factors, often called the Greeks.
Okay, let's get into that because we need to move beyond just saying time is money. What's the technical term for that cost of time?
That technical term is theta. Theta measures time decay. An option loses value every single day because there's simply less time remaining for the asset to reach the strike price.
And it gets faster near the end.
Right. It accelerates dramatically as the option approaches expiry. This is why a near-term OTM option is extremely cheap. It has almost no time left to succeed, so its theta value is just, well, eating its premium alive.
That makes perfect sense why that long-shot $100,000 call costs only $221. The market knows mathematically it's a long shot in that short time frame.
Exactly.
But what makes a longer dated contract, say for February, so much more expensive? The source mentioned something like a $3,000 premium.
That's where implied volatility comes into play. 4 is the market's expectation of how much the price will fluctuate between now and expiry.
So it's a bet on choppiness.
It's a bet on how big the moves will be, up or down. If the market expects high volatility, the premium is higher for all options because there's a higher chance something big will happen. That $3,000 February option is expensive because there are several more weeks of potential volatility, giving that 100,000 strike a greater chance of being hit.
So if there's a big event coming, like a Fed meeting or an ETF approval, IV will spike, and all the options get more expensive.
They do. 4B is a bet on the speed and the magnitude of the movement. And there's one more key Greek we need, delta.
Delta.
Delta measures how much the options price should move for every $1 change in the underlying asset's price. ATM options have a high delta. They track the asset price closely.
But our long shot?
Our $100,000 OTM option has a very low delta. It barely moves until the Bitcoin price starts getting really close to 100,000. And that's another reason it's cheaper. It doesn't give you much in the way of early movement.
So this really shifts the whole conversation. It's not just gambling. It's trading statistical probabilities based on time, which is theta, expected movement, which is IV, and directional sensitivity, which is delta.
And tying it all back to the marginal requirements from the source, we saw trades requiring as little as 85 cents, or that $221 for a full Bitcoin contract. This low entry barrier is why OTM options attract so much speculative interest. You control a huge exposure with minimal capital.
All right, let's run the simulation. Let's create this cinematic scene. You're bullish. You believe the great run is finally coming. You decide to make that highly speculative, high leverage bet. Bitcoin is going to hit $100,000 by the 26th of December expiry.
Okay. You step up to the option chain, you select the $100,000 call, and you pay your premium, $221. That is now your defined maximum loss. You have your ticket.
And the emotional journey begins. You're waiting, you're watching the ticker, the price is slowly rising. It goes from 89,700 to 95,000. You're feeling great, but you haven't actually made any money yet.
And this brings us to scenario 1, the big myth-busting moment. What happens if Bitcoin hits your target exactly? It spikes, it's dramatic, and it settles at exactly $100,000 on the day of expiry.
My gut tells me I've won the bet, or at least I broke even. But I have a feeling the reality is a little harsher.
It's a painful twist. The reality is, if BTC settles at exactly $100,000, your entire $221 premium is completely lost.
Wiped out.
Zeroed out. The option expires worthless. Profit only begins above the strike price. And even then, you still have to recoup the premium you paid.
Wow. Okay, that's a critical adjustment in perspective. The strike price isn't the finish line. It's the starting line for your break-even calculation.
That's the perfect way to put it. You have to cross the $100,000 mark and then run an additional $221 worth of movement just to get your money back.
Which is why these OTM options have such a high failure rate.
Yeah.
You need a massive move.
You do.
But when that massive move does happen, that's scenario 2. That's the multiplier effect that draws people in. Let's use the figures from the source to show that leverage potential.
Okay, so if the market goes on a historic parabolic run, the power of that low premium purchase becomes absolutely staggering.
So let's say BTC hits 105,000 on expiry.
The intrinsic value of the option is now $5,000. That's the 5 market price minus the 100K strike. You subtract your $221 premium and you've made a massive net profit, a nearly 23x return on your investment.
And if it hits 110,000,
the value is 10,000. You've earned 45 times your initial capital.
And if we indulge in that maximum theoretical scenario, if BTC hits a monumental $200,000.
That $221 investment nets you a $100,000 profit.
So the core takeaway is just pure asymmetry. The buyer has strictly defined limited risk, just the premium they paid, but theoretically unlimited profit potential.
It's a powerful but very low probability payoff structure. And let's contrast that with scenario 3. What if you decided that that $221 bet was too much of a lottery ticket, and instead you bought the ATM call, the $90,000 strike, with a premium of $2,517?
Okay, that's a tenfold increase in capital. That's a serious outlay.
It is, but the probability of success is much higher. The delta is higher, so the options value moves faster as the price rises.
So how does that play out if BTC still goes to 100,000?
The value of the contract is $10,000, which is $100K minus the $90K strike. After you subtract your $2,517 premium, you net a profit of $7,483.
A safer trade.
Much safer. It requires more capital up front, but you have a higher chance of a partial return or breaking even with a less dramatic move. It's the difference between buying an investment-grade bond and buying a scratch-off ticket. So now we have to flip the coin. For every excited buyer who paid $221 for that chance at $100,000, there is a seller who took the opposite position.
Right, there has to be.
And this duality is fundamental to understanding the market.
So the seller is the one who took my $221 up front. They're betting that Bitcoin will fail to break 100,000 by the expiry date. They want my option to expire worthless.
And the seller's profit dynamic is the complete inverse of the buyer's. It's strictly limited. Their maximum possible profit is exactly the premium they receive.
Just $221.
That's it. If BTC stays below 100,000, the seller keeps that money, the contract closes. They are essentially selling statistical probability and accepting a small, high probability game for it.
I get the appeal for the seller. It's like being this house at a casino. High probability income.
It can be.
But the loss dynamic, the moment BTC crosses that $100,000 strike price, it just shifts violently. The seller then faces that terrifying theoretical risk of unlimited loss.
And that is the burden the seller assumes for taking that premium. They are obligated to sell Bitcoin at 100,000, even if the market price is 150 or 200,000. They lose dollar for dollar on every single move above that strike. The risk curve is entirely inverted. Limited profit, unlimited risk.
I have to ask the critical question then. If the payoff is so weighted against the seller limited profit, unlimited risk, why would anyone ever sell a naked call option?
That is the essential skeptical question, and it really captures the tension of this market. The reason option sellers exist, especially professional ones, is that they trust probability and, crucially, they employ rigorous risk management. This contrast is captured in that trading dialogue from the source. If you trade in futures, you have no future. If you trade in options, you have multiple options.
That phrase really does capture it perfectly. Futures lock you into one outcome, but options let you choose your strategy.
Exactly. A professional seller isn't relying on blind luck. They're relying on theta decay. They are literally monetizing the passage of time. They sell options that have high theta risk because they know, statistically, most of these OTM options expire worthless.
Okay, but we have to address the safety side of this. We need to myth bust that phrase, unlimited loss. For a newcomer, that is a huge psychological barrier.
It's a critical behavioral and safety point. While the technical payoff chart shows a theoretically unlimited loss for a naked seller, in practice, professional traders almost never let this happen.
They don't just sit there and watch it go to infinity.
No. This risk is actively managed with automated orders. The two primary tools are stop losses, or SL, and hedging.
Okay, so help me visualize this. If I sold that $100,000 call, where would I set my stop loss?
A disciplined trader would define their maximum acceptable loss before they even enter the trade. If they receive $221, they might decide their max loss is, say, $500.
Okay.
So they would set a stop-loss order that automatically buys back that contract if its price rises by $721, the $221 they receive, plus their $500 loss allowance. The source material really emphasizes this, citing trades entered at $738 being instantly set up with a take profit of $2,500. You define your boundaries before the market moves.
So unlimited loss is really a technical warning about the inherent potential risk, not the actual managed risk.
That's it. The seller has to be more disciplined than the buyer. The buyer can afford to buy the ticket and forget about it. The seller must actively manage their position to prevent a catastrophe.
Okay, we've built the foundation using the call option. Now we have to complete the alphabet with the put option and then move into those huge books and scriptures of combination strategies.
Let's detail the two put option dynamics. When you are buying a put, your expectation is that the price is going to drop.
Right.
It mirrors the buy-call structure. You pay a premium, your risk is limited to that premium, and your profit is theoretically unlimited if the asset's price collapses towards zero.
And the counter position is selling a put, which is kind of counterintuitively a bullish or neutral position.
Correct. When you sell a put option, you receive the premium upfront, and you're hoping the price will rise, or at least stay flat, above the strike price.
So your maximum profit is just the premium.
Right. But this is where that unlimited loss risk reappears. But on the downside, if the market crashes, the seller faces that unlimited loss because they're obligated to buy the asset at the strike price, which is now way above the market value.
Okay, so we can finally summarize our ABCD, the 4 primary moves. Every directional prediction has a choice.
A choice between a limited risk, unlimited reward structure, which is buying, or a limited reward, unlimited risk structure, which is selling.
So to be bullish.
If you're bullish, you can either buy a call, which is high reward, low probability, or you can sell a put, which is limited reward, high probability.
And if you're bearish?
If you're bearish, you can buy a put, again, high reward, low probability, or you can sell a call, which is limited reward, high probability.
And that choice, that ability to pick your strategy based on your risk profile and your statistical preference, that's the core advantage here.
But the real power, the architectural genius, lies in combining these elements. Like the source material says, these 4 moves are the alphabet, but combining them lets you write huge books or scriptures.
Complex strategies.
Complex strategies designed to profit not just from direction, but from range and time, while critically managing risk.
And this is where we bring in the idea of hedging. This is the mechanism that finally eliminates that terrifying unlimited loss scenario for the seller.
Hedging means combining buying and selling different options, different strike prices, maybe different expiries, to synthetically shape your payoff graph. A single naked option is high risk. A combination trade, often called a spread, locks in both a maximum profit and a maximum loss.
Okay, let's take the time to walk through the case study from the source. Creating a triangle strategy. This sounds like a step-by-step journey that requires some precision.
Let's do it. The goal of the strategy in the source was this. The trader wants to profit if the price of Bitcoin stays within a defined range, let's say between $80,000 and $100,000, while strictly limiting their losses if the price moves outside that range.
Which is something you just can't do with futures. If the price stays in a range, I make 0 profit, and I might even lose money on funding fees.
That's the innovation. To create this triangle payoff, the trader executes a 4-legged transaction, 2 put positions and 2 call positions. It's usually a combination of selling options to collect premium and buying other options to provide insurance.
Walk us through that protection mechanism. How do they get rid of the unlimited loss?
They execute what's called a call spread and a put spread.
Okay, the call spread first.
For the call spread, on the upper limit, they might sell the $100,000 call option. That collects premium, but it also risks unlimited loss above that price. So immediately, they buy a higher strike call, say for $105,000.
That's the insurance policy.
That's the fence. The difference in the strike prices, $5,000 limits their maximum loss on the upside. If the price goes to $200,000, they lose $100,000 on their short call. But their long call at 105 becomes worth $95,000, so their net loss is capped.
And they do the same on the downside.
Same thing for the put spread. They sell a put at a high strike, say $85,000, to collect premium, but they immediately buy a lower strike put, maybe at $80,000, for insurance. This caps their loss if the market crashes below $80,000.
So by simultaneously selling the options closer to the price to collect premium and buying the options further away for protection, they've engineered a structure that's profitable if the price just stays still.
Yes. And the outcome of that setup in the source material really demonstrated the power of this. The resulting graph was a clear triangle shape. It completely eliminated that terrifying exponential loss curve. The analysis showed this approach yielded a potential profit of $3,000 while rigorously defining the maximum capital at risk to only $200.
A potential $3,000 profit for only $200 at risk if the market holds steady. That just flips the entire script. I'm no longer betting on high volatility. I'm monetizing my belief that the price will stay in a range, and my max loss is absolutely capped.
This is the mastery of options. It's the move from simple speculation to complex strategy design. You sacrifice the lottery ticket upside, but in return you gain certainty, you eliminate catastrophic risk, and you open up profit potential in a sideways market. It's an intellectual pursuit. Hashtag tag outro.
So we've completed a pretty comprehensive journey today. We've gone from the simple mechanism of futures to the nuanced complexity of state of decay, implied volatility, and the geometric architecture of that triangle payoff graph.
And the central takeaway for you, the learner, is that options are just a superior tool for customized risk management. They let you define your exposure and your profit potential in ways that standard futures just can't.
And this level of sophistication, it naturally leads to the future vision that the source material touched on, which is automation.
Right.
When you have a complex, multi-legged strategy like that triangle spread, managing it all manually is just prone to human error and emotion.
The goal is to encode your trading philosophy, your rigorous, disciplined logic into an algorithm. Automation ensures that trades execute according to that predefined logic, managing those 4 simultaneous legs, adhering to that $200 maximum loss even while you're sleeping. It removes emotion from the equation.
And before we automate our psychology, we need to understand it. So we want to prompt you, the learner. Based on everything you've heard today, which side of the options trade better suits your inherent personality?
Yeah, are you the high-risk, high-reward, unlimited profit buyer, willing to stomach those frequent losses of small premiums for the chance at that enormous payoff?
Or are you the calm, risk-mitigating seller? The one who prefers consistent, high probability but limited profit, all backed by rigorous hedging and spread stretches.
If this deep dive into delta, theta, and architectural risk has sparked your interest, the educator in the source material detailed several, really robust and practical tools to take the next step.
Yeah, you should definitely explore the educational paths they mentioned, the webinars that break down live trading scenarios, and the Google Forms that grant access to their inner community and Telegram groups where these concepts are actively discussed.
And for those who are ready to move from concept to full implementation, there was specific mention of a comprehensive, paid 5-day automated trading workshop.
And the structure of that is built to encourage commitment. They offer a refundable fee, but it's contingent on full attendance. It ensures you internalize the discipline needed to make that shift.
From a speculative mindset to an architectural one.
Yeah, okay.
Ultimately, understanding options isn't just about executing a trade. It's about mastering probability and designing your own financial risk architecture.
So we'll leave you with this final provocative thought. You've seen how you can design a financial instrument, that triangle payoff, where you define your maximum potential loss down to the dollar before you make any commitment. What other significant decisions in your life, a career change, a new business, a large investment, could be optimized or de-risked by adopting this options-based mentality?
Define your maximum risk first and only then commit the capital.
That's it for this deep dive. We hope we've equipped you with the advanced vocabulary you need to start designing your financial future.
We'll catch you on the next one.